Hello, Kirk Spano here with Scott Shooter Henderson and Theresa May, the former Prime Minister of Great Britain, nice enough to join us tonight. We are going to be talking about all things European Union and wait. Is it a different Theresa May? Are you that
It,
Theresa May? Or are you a
it
different
just
Theresa
might
May?
be. Yeah,
Oh,
it's a different. When I went to England when she was prime minister with my passport and got double looks. I'll say that.
that's funny. That's funny. All right. All right. So anyway, we're going to talk some macro, and this is going to be a very chart heavy presentation this month. Most of what I've been saying in articles and in the Monday webinars for the retirement income options, which gets, stocks of the week and macro mixed in. So I wrote this article 2 weeks ago, give or take. A credit crunch is coming soon. And I summarized the different credit problems that are all manifesting at the same time. I think that because we have learned to use the quantitative easing medicine, and since we really overdid it after COVID, that it is hard to put a time frame on when all these credit factors kind of line up. I was saying in 2021 and 22 and 23, and even before COVID, that it looked like sometime between 2026 and 2030, there would be a credit crisis in the United States. I did not anticipate President Trump being president a second time. And I think that we have changed the timeline a bit as far as, politicians being politicians. That's what they do. They steal money and they change timelines, or they waste money and they change timelines. You pick which party does which. I think that we are probably going to see a double dip economic slowdown. I don't know if the first one is technically a recession. I am certain that at least one of them will be, if not both. And I believe that the culmination of all these credit problems will be really the domino string that gets tipped over. And it's not really the tariffs that you should worry about directly, because financially they're not a big deal. They really aren't. Only about a quarter of the US economy is imported. 3/4 of it is domestic. So if we put a 10% tariff, which is the baseline that they've established, which I said would be the baseline, everybody's like, I'll go back to zero after they negotiate. No, 10% is the baseline. But 10% of 25% is only 2.5%. So the tariffs conceivably could add about 2.5% in price inflation. That's the easy way to think of that. But the movement of supply chains is monumentally slow and expensive. And that can also add to inflation. And that is what people don't model out is, okay, let's use Nvidia as an example. Nvidia is basically not going to be able to do any business with China anymore. They have some of the tertiary business, but even that's going away because they are producing in China everything except the very high-end GPUs and processors. So whether it's Huawei or one of the other companies there, Nvidia only has an edge in the very top end of the market. And why would China buy from Nvidia when they can buy from domestic companies? They're not going to. So Jensen Wang, he registered to sell $1 billion worth of shares. $1 billion. That's a lot. That's a lot for somebody to sell in a company that they've built up. Why is he doing it? Well, at the same time that he did that, they also filed a shelf registration to raise up to about $10 billion to move supply chains from China, or being China focused, to Middle East focused and India focused. $10 billion. Now, Nvidia is a big company. It's not really going to cause a lot of sweat for them. But consider all of the other industrial supply chains that have to move. Think about cars. Think about everything. Think about cell phones with Apple. That will be inflationary too. Now, why does that not scare me a lot? Because if you've been listening to me for years, you know that I think that as the baby boomers finally, the last ones are retired near the end of the decade, that is a very deflationary event that'll last 10 to 20 years. At the same time, we have fourth industrial revolution technology coming, and that is disinflationary once the build outs of the supply chains are gone. So what you get is a lumpy period that's front loaded with a little bit of inflation from the tariffs and from the supply chains moving and from the ramping up of certain production. But then the demographics, which are bigger than everything, start to take hold, and robotics, which will be the biggest industry in the world in the next decade. Stop, check the telegram. Yes, he just said robotics will be the biggest industry in the world in the next decade, and it will be. There really is no way for that not to be true. And I don't just mean humanoid robots, which will be gigantic, but I also mean everything that goes into production. When you listen to Scott Bessent or Lutnick or Navarro or further down the moron chain, Bessent's the only smart one there from what I can tell. Everybody else is just a money-grubbing capitalist crook. Unlike me, a money-grubbing capitalist nice guy. The factories that they talk about moving to America, they have come right out and said they will be largely robotic. So the jobs that are created, anybody who still holds on to the idea of assembly lines with a whole bunch of people there turning screwdrivers and pounding stuff in, I mean, watch different movies. The reality is that we're going to have so much robotics, and I've said this before, and some of you will remember, why have so much trade if a robot here is the same as a robot there? A lot of global trade developed because there were disparities in labor costs. A robot here or a robot there going to cost the same thing. So self-sufficiency is becoming the name of the game. And where the resources are is important. United States is in the catbird seat there. We have everything. That's probably the real reason President Trump wants to have Canada become a state. But really, there's 9 provinces, I believe. They'd probably be 9 states. They'd all vote Democrat. So I'm not, maybe 8 out of 9 would vote Democrat. So I'm not so sure the Republicans really want that. The future of production is more local. The future of services are more local because AI makes it easier for people to do all the in-between things that a lot of consultants were doing. If you are not a hands-on, personable service provider or an outright expert, if you're just in between, you're kind of okay talking to people and you kind of know what you're talking about, you're in trouble. You need to become very good or very empathetic and very easy to communicate with. So in the factories, there will still be people. They will be relatively highly skilled for when the robots break. And then you'll have some middle skilled people who work with the robot or the machine. That shift of the way that supply chains are, and it was coming anyway. We've talked about this for years. Trump didn't bring us anything new. He just decided to play hardball with the rest of the world. And honestly, I'm not so sure that's the wrong decision on the financial side, but on the diplomatic side, I still think it probably should have been handled better. And I also think that the dismantling of regulation in the financial sector is going to have a comeuppance. I think the expansion of private credit to the point where underwriting has become worse is going to have a comeuppance. I think not treating our allies like allies has potential to have bad things happen. Here, I'll point out to those of you who've been paying attention, when the Ukraine invasion started, I said it wouldn't matter to the stock market within 3 months, and it didn't. But I said all along, it could be a long, drawn-out thing because the military-industrial complex makes a lot of money on wars. And what just happened? We just saw a bunch of toys blow up a quarter or potentially a third of the Russian bomber fleet. The future of warfare is asymmetric, mechanized, and horrible. And we had better get control of the military-industrial complex quick, or something really bad can happen. Does anybody put it by Putin actually using a tactical nuke right now? I don't. And what can we do about it? We're not really going to fire a nuke back at him. It's important that we take a look at the big picture, not only for our own livelihood and for our own life, our children's lives, when it comes to things like international relations or climate change, the way people live in other parts of the country. Remember, Nixon identified that working with China would keep them from being hungry cold, and angry, which is usually why people start wars. World War II Germany, that's why they did it. We oppressed them after World War I. They got so angry that for a decade they foamed at the teeth, foamed at the mouth. Hitler got power, and you know the rest. World War II, the Holocaust, nuclear weapon. So while I have said as far back as 2017 when this all started, really the personality phase. This all really started in 2010 with the Tea Party. It was very angry about a black man being president. But as the United States came back from the financial crisis, we kept doing the same things that led us to the financial crisis. And now we're putting the pedal to the metal. And that's at least where the credit crunch is going to come from. Commercial real estate, biggest defaults in history. The banks have been stretching it out. Extend and pretend is what it's called. The United States government is pushing $40 trillion of debt. Suddenly, debt of all sorts is going up. Student loans just shot straight up because they got rid of the deferrals and forbearances. The important one to watch is cars. Why cars? Because people hate losing their cars. And we are at that magical 5%, which is financial crisis, COVID, and now. Credit cards are full. So when they talk about how much cash people are holding in the bank, the thing is it's because they're using their credit cards. At some point, the credit card bill comes due, the bank account empties. What happens if we get an uptick in unemployment? Now, so as all these different credit crises come together, so you take a look at what they might do with the big skim bill. I think that it is interesting that for the fourth time in my life, the party that talks about keeping the debt low is going to blow it out for a fourth time. Interesting. And the thing that you better worry about that I talked about last month, and I just want to bring it up again, is crowding out. Because all these debt issues, whether it's the more than 6 million houses that are on the brink of foreclosure, with a lot of them in Florida, whether it's the regional banks with their problems with commercial real estate, whether it's the federal government, whether it's corporations that got all those super favorable loans during COVID because, remember, the Fed was buying the bonds. Now they have to finance them out again because they're generally 5-year bonds. They're going to be at much higher interest rates. So that's going to put some pressure on profit margins, which will be offset by AI, which means maybe some unemployment. We are in an age where things are, in fact, moving faster than ever before, and the impacts on supply chains and employment are going to be large, I'd say, over the next 10 years. And what do we know about transitions? People don't handle them well. You change somebody's life, they damn near go crazy sometimes. Now, should it be that way? Nah. In poker, we call it embrace the variance. Stock market, it's called volatility. In life, for probably 60 to 80% of the population, they use an acronym FML. Anybody know what FML is? It's that other word that sounds like Zuck, my life. Emotions run high in humanity. Fear and greed run rampant in financial markets. Fear is 3 times more powerful than greed. We've been able to measure that over decades. So when the fear comes, it probably will be substantial. And everybody right now is saying, but they'll just do quantitative easing. Again, come back to crowding out, macro 102. If the government takes up so much of the capital, that means that it doesn't flow back into the private markets. And in these cases, what Basenta said he wants to do is term out the debt. He would like to issue 3%-ish 20-year bonds. The problem is, who would buy them? Nobody's going to buy them. Nobody wants to buy 20-year U.S. debt at 3%. Now, if we get deflation in the 2030s, which is what I think is going to happen, then it's actually not such a bad deal. But right now, everybody thinks we're getting inflation, and sometime in the next few years we will, because Saudi Arabia can't keep oil cheap very long. In fact, I think that the reason Saudi Arabia is pumping more oil right now, partially to appease President Trump, but partially because they know that there's an attack on Iran coming. I've thought that attack was coming for 8 years. Given that they are at the point of basically having nuclear weapon ready materials, finally took them, couple decades, but they're there. And the fact that Israel and the United States now have been attacking them. Remember, we just bombed the Houthis twice. Unfortunately, I think that probably there's going to be a bombing of Iran. It won't just be the nuclear facilities. It will be targeted at leadership, and they probably have one or two of their main petroleum facilities hit as well. And I'm not so sure the United States wants that part of it, but Netanyahu, who's kind of on the rocks right now, I think is going to try to go out with a blaze of glory, at least in his mind. We'll see. Those are some of the black swans that could come out of the sky. More importantly, less importantly, other importantly, the debt crisis that's coming, I think, is unavoidable. Some of you will remember the financial crisis in 2008. I know there's a couple dozen newer investors with us, and I don't know how many of you are younger. But in January or February of 2007, Bear Stearns had two debt funds go under. That was the harbinger. That was the red flag that there was a credit crisis coming. I think that the three regional banks that went down 2 years ago were the warning for this one. And that is why the commercial real estate mini crisis, really, I mean, it's the worst we've ever seen. But the extend and pretend has worked, right? They're just not making the banks declare the losses in real time. They're letting them stretch them out by saying, oh, well, we're working with this guy. Hasn't made a payment in a year, but it's not technically a foreclosure, you know, when it comes to some of those big buildings. Just had 4 buildings in Milwaukee in foreclosure in the last year, big ones. Like I said, last year in San Francisco, there was a bunch of them. Austin, right? Boomtown. Austin was a boomtown. Suddenly they're having foreclosures. There's a lot going on. And weirdly, I just look at it as a trading opportunity. I do. Because I still think the world gets better over time. It's just not in a straight line. 2 steps forward, a step back. And I think the next step back is soon. But maybe it takes 3, 4, 5 years. If that's the case, I'll play some of the rebound rallies on the smaller corrections. And I'll stick with my favorite catalyst-driven stocks. Remember, 80% of the stock market is uninvestable individually. You really just don't want it. And it's probably closer to 90%, right? You really want to stick with the great companies. I mentioned this the other day. Or companies that you think can be great. Why would you aim lower? If you aim at the top 10% of companies, as far as you can tell, you'll still be wrong, and you'll get companies that aren't in the top 10%. But you might as well aim at companies that you think can be top 10%, because equity risk is relatively similar across the board. Small caps, mid caps, large caps. Micro caps a little bit different, maybe a little bit higher risk. They still have a lot of financial problems. But once a company is financially able to get credit, then it's just a matter of do they execute. Handful of companies like Nvidia or Apple go on these amazing 5 to 10 year runs where they dominate an industry. Then they get to the top of their S curve and they might still beat the S&P 500 for a while, but the hyper growth is gone. So our job is 2 things. Our job is to be invested in the industries and sectors that are consistently beating the average. We know that except for recessions, consumer discretionary beats the S&P 500. We know that technology beats the S&P 500. As it's constituted now, communications beats the S&P 500. They rejiggered those sector ETFs a while back. Now Google and Meta are communication companies, right? It used to just be the phone companies, but there's only a couple of phone companies left. They had to figure out something, either get rid of the sector or change who's a communication company. And that's what they did. They just changed it. So if you take a look at the holdings in XLC, communications ETF, it's not just AT&T, Verizon, T-Mobile, Google's in there, Meta's in there, there's some others. So you want to be in the sectors and industries that consistently beat the stock market, because you can buy that group, avoid the single stock risk, but still beat the index by 2, 3, 4 points. We also know that the momentum-driven ETFs beat the standard ETFs that are market cap weighted, which are really super slow-moving momentum ETFs. The ones that update every quarter or every month tend to do better. And we've shown those charts before. The S&P 500 momentum ETFs beat the S&P 500. So if you want essentially an S&P 500 fund, you can buy the momentum fund, It'll be in 200 to 300 companies at a time, still plenty diversified, and it's the ones that are going up more. Well, that's nice. So that's the asset allocation side. On the stock picking side, there's different things you can do. If you are a dividend investor, high dividend yields don't typically beat the market over time. Growing dividend yields typically do. And growing dividend yields come from the underlying growth of a company. So a big company paying out a high income, but that's not growing, typically a recession or some financial event makes them cut their dividend and the stock crashes. That happens to well over 1/3 of them every recession. And that's why I don't chase the biggest yields. Now, if I can find a 6, 7, 8% yield and I can justify the growth of the company as being rational and being able to support that dividend, hey, great. There's just an article out about Warren Buffett's company, Berkshire Hathaway, collects like $4 billion a year in dividends. Yeah, but none of them are 8% dividend yields. They're all 2, 3, 4%. They have made some vulture investments, like with Occidental, where they loan them money through preferred shares or debt. They get 10 or 12% on that, but then they get a warrant kicker to buy shares at cheap. So it's the growth in dividend growth that's important. And that batch of stocks, we know statistically and over a long period of time, beat the ones that are paying out 8, 9, 10%. Because the odds of a company that has growth that's growing their dividend, slashing that dividend is almost zero. Literally, it's almost zero. It has to be some sort of catastrophic event for the company. But the companies that pay high dividends, 1/3 of them cut their dividends in recessions and they crash. Interestingly, some of those companies are pretty good buys on those crashes. And some of their convertible debt, which I haven't bought in 17 years, theoretically could be a pretty good deal. The other thing to invest in is small and mid caps that are execution driven and have a line of catalysts that can push their stock prices higher, regardless of what the broader market does. So when you take a look at my portfolios, it is a combination of dividend growth stocks, high upside stocks that have execution and catalysts that outweigh the market, and then just being in the right sectors and sometimes countries. That is investing in a nutshell. And if you think there's more to it, I'll put my now 8 figures up against yours. People talk to me about trading all the time, especially younger people, and I get it that you want to trade your way to a big pile of cash. Very, very few people can do it. And if you don't have enough capital and you quit your job to trade with 50 grand or 100 grand, you're probably in trouble. Now, if you're a millionaire and you decide to trade your account, that's different. You have capital where the trades are big enough to make you a living. But giving up an income to manage a small amount of money, typically a horrible idea. So I will just throw this out for the younger people, is trading is nice, but not if you have to give up an income. You generally need, to my way of thinking, you generally need $500,000 to start as a trader. And nobody does. Everybody just thinks they're going to have magical money and everything's going to work out. So I'm going to tell you something. We're going to look at some charts in a couple seconds. The trap door in these charts that we're going to show you, I don't know if it'll be opened, but I think the risk is there. There are your normal pullbacks that you experience during any broader bull market, but then there are bigger pullbacks. There are elevator shafts. If this happens, and I'm going to tell you, it is going to happen. I can't tell you if it's in the next year or if it's 4 or 5 years out. I think it's 2 pieces. I think one piece now, one piece later, now and later, used to be a good candy. I think we get double dip slowdowns. Not sure if they'll both be recessions. I think at least one of them will be. So when you manage your money, I don't think we're in a time period over the next 5 years or so where you can set it and forget it. I think you need some management. I think it can be week to week. I think it'd be 15 minutes every other night, 20 minutes every other night where you take a look, see what your orders are, see if anything did anything weird. I don't think you have to look at a computer 3 hours a day. I mean, if you are trading because your hours allow it, your circumstances allow it, that's fine. But I manage other people's money. I take a look at the market for an hour, 3 different times during the day. So I'm looking at the computer 3 hours a day, but then I do research another 40 hours and then I write for 15 or 20. If this happens in a couple different pieces, here's the good news. Because a lot of us are heavy in cash, you should get some really good buying opportunities. But if it's a 2-piece, right? If it's if it's a head and shoulders over the next 4 or 5 years, that means that you should be cash heavy now, buy the next big dip, ride it for a year or 2 or 3. We'll see. See how big the next QE is. But then you'll want to trim, especially if you double your money, and especially if you triple your money. So, all right, let's look at some charts. This is TLT. People ask me about, should I buy long-term treasuries? Well, I've called it recession insurance. The problem is that this buy zone that we're on top of again, it can break. If we get crowding out, right? If we get crowding out, and Stanley Druckenmiller, who's a pretty smart dude, if he's right, and the 10-year treasury goes up to 6 or 7%, then TLT is going to go way below the support line. Shooter, are you on?
Yes, sir. You hear me?
Yeah. Do you think there's enough buying pressure in here to reverse this and flex it up? Or do you think...
I don't think it has anything to do with buying pressure. I think it has to do with the pressure on freaking the short term and how much gets sucked out of the long end of the curve, just to be
right.
So
right. How high do interest rates go?
The numbers that I'm hearing, 6.3 to 7.5 with the current numbers, that would mean that TLT would break towards 7.
Yeah. So when people ask me, should they buy TLT, it's a complicated answer, right?
Yeah, very true. I already tried to get long twice. Once it worked. Second time I got stopped out.
Yeah.
And that doesn't happen to me very often.
Yeah. So I think, depending on how things go in the next several months, if the government doesn't start to get crowding out, and I think the thing to look for is, are the international players buying our debt or not, right? If the bond vigilantes, which are the domestic guys mainly, but if the international people, the international investors in U.S. bonds, if that even flattens out, much less goes down, that forces interest rates up, which means that this can break that green line. Normally, that green line is a pretty good support zone, correct?
Yes. Matter of fact, I just posted a bearish count if that trend support breaks or that demand zone. It's at the bottom of the list of the charts that I put in.
So we have another chart in the service that shows what could happen if interest rates do in fact go into the 6s. Right. Okay. No, that's fair. I just want people to understand that just because this has been a support zone doesn't mean it can't break. And when you take a look at this, this has been 1, 2, 3, 4, 5, and then could this be an ending diagonal? Is that kind of what that would be?
Yeah, it could be.
But we don't know.
It's when you get a slow bleed, you tend to have these extended mounds, as I call them.
Okay.
So they're flatter and longer, and they're not as cascading as a bullish mound would be. But quite often you have a flat that builds out that is equal to about half of the whole downtrend. Now, if you can just look at that chart, so the right-hand side of that chart is what, maybe 1.5 inches now at this point?
Yeah.
And you go the entire downtrend, what is that, maybe 4 inches?
Yeah.
So we could be in a flat here for another inch. So that would be out to 2026.
Which is the year that I've pointed to.
Yeah.
Well, we'll see. Okay. So that's the answer on TLT. If you're going to get into it, I think you scale in super slow. I think it kind of becomes a no-brainer down here. And I like no-brainers. So to me, this is a harder decision. I try to avoid harder decisions. This is a pretty easy decision. Would you agree? If it gets down to around 70, you just hold your breath, right?
Yeah, because it's going to get an $8 to $10 jump off of 73.
Right.
I mean, we'll see clear divergence down there. I mean, we should be able to get a good bounce off of that.
Okay. All right, let's go to the S&P 500. This is Shooter's weekly chart. What does this tell us today?
Well, it tells me we're extending. I mean, it looks, this count actually is very shallow. Realize the 161.8 is way the heck up off of where this count is. If you look at the euphoria that we see in this, if this holds and we break out to do highs, we're going to have a flux of money come off of the sidelines because now that FOMO is going to be maxed out. And it depends on how long that lasts, how hard we could push. So, I can see us breaking out from here. I think that 620 is conservative, and I think 667, 670, maybe even 700 is viable with that kind of breakout. And we are starting to see that in flow and options going out, later into August and September and even January 26th. We're starting to see more and more of the flow step out in time where they're buying larger positions.
So my experience here tells me that a spike up could happen. I think it's a coin flip. However, if it does happen, it'll be a sell almost everything moment because
Mind trend support.
Yeah, well, and so historically, when retail, which is twice as big now as it used to be because of all the trading and Robinhood and things like that, when retail is buying from the sophisticated investors, which used to control 90% of the money, now they control about 80%. That's usually been bad for the little guy. I think because there's more little guys right now, they can push it a little bit further. However, the international investors are sophisticated and the money managers are risk averse. So there really isn't that much money on the sideline, but they are levering up. So I think they're going to try to push it through this resistance. Do you think that?
I agree.
They're going to try.
I mean, we need a catalyst here to bring us back down. And one reason I have my risk trend support set at 574.98 is because that's an internal trend support. That breaks, then we'll roll down and probably back test that 50 fib around 550. So, we'll have a good $20 move to the downside, and we will probably find some support there. And that would be enough of a launching pad to get us back up towards that 660.
Yeah.
Is my thinking. We need BOG to break, right? We need something in the banks to break. I mean, it at this point with the flow that I'm seeing and how you just can't. I mean, I'm catching like 2 or 3% on my scalps, so it's very emotional right now. Any dip is just getting a realm of orders that are coming in.
Well, and I would point out that my portfolios are up about 1% today. I'm 60% cash with a short hedge that lost. I still made a percentage point today. Doing nothing, just watched it. I was like, I was just like, some of the stocks were up 10, 12% today. And that's with the S&P 500 being up. What was it up? It was like flat today, wasn't it?
Yeah, just 3/4 of a point, I believe.
Yeah.
0.62 or something like that.
So it really is hot market, cold market. I think that it's going to hit in here, and then we're going to have to wait and see. Then either it jumps pretty quick to here, and maybe it catches more FOMO and it gets all the way up to here. It's not a game. I'm not trying to get that puff on the cigar.
Yeah.
I'm really just looking at my favorite stocks, which you know what they are. I mean, one of them, one of our space stocks was up 10% today, something like that. Our beat the hell natural gas stock was up 10% today. So this is important for people to understand. If it breaks out of here, if this doesn't get rejected, then it can keep going up, right?
Yep.
So
but we are in a bullish mode. I really was. It was not visible outside of the fact that we, as soon as we broke trend support, I thought we were done and I would roll back over, but we've completely bought that back.
Yeah.
We didn't even get to the 236 fib on a retrace. That's extremely euphoric. Yeah. My tone completely shifted there, and I shifted out even to some January call. I took deep out of the money calls on some names I really liked because I wanted the upside exposure, and I still saw some heavy burden on the Mag 7. I think it's a mixed bag there. I think you got me to Microsoft and Google that continue to do well. And, Tesla's one that's rolling over already. And it's questionable whether or not Amazon does. So I think there's enough strength in earnings and not a lot of bad guidance where, we're not really in a bad place here. Even with the horrible jobs number, 37 or 67,000 new jobs or whatever it was, it's still not horrible. I mean, we're not losing 250,000 jobs a month. We're coming off of a peak. So if you look at the fundamentals of what's going on in the market across the board, I mean, we are not in bad shape considering what just happened with the tariff news. I mean, we're not. I mean, realistically, we should be 50 points lower than where we are now, and we're not. And
okay, so from a technical standpoint, somebody in the chat says this is a melt up. It's not a melt up. I talk about using the terminology correctly. This is a spike. This is
It's a distribution, to be candid. You're getting rotation out of the Mag 7, which was such a big chunk, right?
right.
And they're looking for yield. They're chasing yield. You can see it in the pumps. That's why you see a stock pump up $15 and then it gives back 12, right? And then it goes to another stock. Same thing. Pump $12, gives back 70% of it. The reason is because the algos, I think they're getting better with AI, by the way, but I mean, they're just rotating in and out of names that are oversold. And then they pump it a little bit, and then they're back out. Then they're chasing something else. That's one reason unusual option flow, I think, has been so successful for me this last quarter, is because we can see it there. We can see where they're shifting. You just have to spend the time to look at it.
Right. And that's for trading. Somebody's asking, if I'm 60% cash, what should I do with the money? Well, to me, you just leave it. Right. I mean, if you're a chaser, then you know what you're doing already. Then you know how to chase. If you're not a chaser, don't chase.
Yeah.
Here, I just want people to understand that this came off sharp, which is typical of a correction. And this sharp rally is atypical. This is an unhealthy rally. Doesn't mean that the market can't be irrational for a while longer. It can be. Markets can stay irrational. And I want you to understand your own personal philosophies, everybody. If you trade regularly, then you're not asking me what to do. You're going into the trading room and you're picking out 2 or 3 ideas. If you are not a trader, well, don't think about doing it now because you're just going to get hurt. That is the lesson. Here's a statistic for you. Every single year, around 80% of the people who trade report a loss on their taxes. 80%. That's a fact. That's a historical fact. Sometimes it's 70, sometimes it's 95. But on average, 80% of short-term traders report a loss on their tax return. That means that all the excess returns, all those people who are losing money, that money is being made by 20%, and really, it's only the top few percent. It's the shooters of the world. It is incredibly difficult to be a trader unless you understand the technicals, you understand the money flows underneath, and you have a mentor. It is harder. I am more likely to hit a home run off a major league pitcher than most people are to be able to trade profitably for a year. And I say that as a guy who hit 1 amateur home run. And there was no fence. I just ran fast. So I want people to understand that in this big picture here, it can break out and they would just represent a taller spike. And then probably it falls off a cliff. And I would just point out that look how long it took to get from here to here. Look from here to there, but then from here back. That is 1/4 of the time frame, 1/5 of the time frame. Shooter talks about time frames all the time, right?
Yep.
I mean, to get from here to here took 2 years, and we just did it again in 3 months.
Yep.
Right? There's something wrong, folks. Look how long this took. Right? That is an unhealthy move. And we'd have to stretch the chart up and down and wide. Yeah. But you can see that out here too. And before the QE age. So the distortions from QE are still real. All right, Teresa, are you here, Teresa?
Yes, sorry, present.
Okay. We were boring you. So tell us about your chart. What are you seeing in your supply and demand zones?
Yeah, this one right here, this is the weekly chart. I concur with what you and Shooter were talking about. You can see from the way that I see the charts, the price came up close to that weekly sell trim zone. And what we would really expect it to do is to come up there, it gets close, maybe kind of hard and rapid and hit it and then fall back, but it didn't. It hit it and it came back a little bit, but it's consolidating there. That's telling me it's going to go through. It's going to go through the top. And that'll redraw the trend. That'll redraw the trend line. Very steep, and we're going to be very extended. That's what I see.
So a Shooter, you can see her RSI chart here, right? You're the mound guy. Is it likely that this breaks through 70 or kind of hits it and reverses?
It should be honor the slope of the first mound. So go back to August of 2024, your lower low in RSI.
Yeah, in here.
Left.
Yeah.
And that slope from the peak at roughly July, the end of July.
Yeah.
straight down, should honor that slope. So it's going to be like a squeeze look to it. It will continue to consolidate.
So okay, so that's right about at 70. So it probably shouldn't go through 70 is what
I
you're
would
saying.
not think so here.
Okay. All right. That makes sense to me. All right, Shooter, here's your monthly QQQ. So this is your long range, right? This is a really long-term look.
Correct. Yeah, if you look at the impulse leg, which is at the left side of where risk trend support is at that 515.99, there's a internal impulse leg. So what I'm looking at is, that roughly that wave 5 puts us up around 579, if I'm correct.
Okay.
You can't see the right-hand side of the screen at this point. But that trend support, once that breaks, I would be trimming because we could roll back over to about 511 first before we take that initial push up towards 600.
All right. And if we get an event, if we just get, all the traders decide to go on vacation in July, they all go to the beach. If they're not renewing their leverage, right? If they stop renewing their leverage, which I think a lot of this is from the leverage, all the leverage numbers say so. So if the retail guys, for one reason or another, stop using leverage or use less leverage, this will weaken. How have you found a good way to measure the impact of what that would mean? Can this end up so like in an ABC correction, this would not have gone to a new high?
Correct. Well, there was an ABC. It's just
you can't see it here.
Yeah, it's that the dip was an ABC, but it extended just a little bit, and it didn't roll over like you normally see in a corrective pattern. You have usually at least 2 drives in a corrective trend, and we did not get that here, and that makes it very challenging from an analyst standpoint because you're not getting your confirmation to the downside that it's done at all. You have no confirmation on that retrace. So
yeah, have they started telling you what's going to be in the Truth Social post before they come out?
No.
I wish we knew that.
I mean, we can see it when it posts.
I know. I'm just teasing you. So when you take a look at your RSI here, where would we expect? Is this going to do another mound?
Should be a higher low in RSI.
A higher low in RSI, and if it's not,
I mean, excuse me, I said that incorrectly. A lower high.
A lower high.
Okay. If it breaks above that prior high, we're going to. I mean, we're guaranteed all-time high. It's confirming. So at that point, you would expect at least one more divergent higher high in price and a lower high in RSI.
So the signal we're looking for is, does this set a higher RSI than over here?
Correct.
And if it doesn't, then okay. And then if it doesn't, we get a correction.
Yeah, I mean we're too high in price already. It's already diverging, right? It's just the question here is, do we get does it end in drive 2, or do we get a drive 3? I think we get 3 peaking drives because in the larger structure, especially within primary waves, that's usually where you're talking, so it's sort of like cascades and rolls over kind of thing. And it's still developing. I've got, we might get a little bit of a shorter term pullback. I've got the 6. I mean, if we don't pull back into the end of this week, we might not run a retrace till the end of this month, and realize seasonality to usually the low for the summer comes in the first week of August. So that means we have the rest of June to run and most of July, and then we're going to turn over somewhere between the 2nd, 3rd, or 4th week of July, and then finally find our bottom or low for the summer that first week of August. And that happens, nearly 80% of the time, as far as the summer lows. Right. So structurally, when we look at history, we can get a picture of where we think it might go based on the previous actions of buyers and sellers in what I call the FOMO, or fear of loss, the fear of missing out, or the full. And I think that's the case. I mean, I'm extremely bullish here. I wish to God I could get rid of the black swan weight if we didn't have BOJ.
And remember, when Shooter says he's extremely bullish, he's a short-term guy.
Yes.
So that's short-term. And again, I think it's a coin flip if this breaks out. I think that retail is willing to take that risk. the traders are. And
Actually, it's light. I actually posted something in on Twitter that showed the divergence between the $1 million orders and the $100,000 orders. Now, usually what I do is I look at $1 million orders, 500K orders, 250K orders, and once in a while I'll go down and look at the 200K order. And the normal 500K orders are down at 100K. So everybody is playing smaller position size. I mean, breadth is clearly waning as far as order size. So I think everybody's in the same boat with me. I mean, it's like, we got to get a piece of this because it's what we do. But we're not in a normal position size because we see adverse risk from things like BOJ, et cetera.
Right. So I'm in 2 Discord rooms, and then I do that show on X, and it's tens of thousands of traders. It's unbelievable. The way they talk, I don't know if that's the way they think, but the way they talk is that risk is meaningless. And I think for a lot of them, well over half, they probably don't have a concept of the risk they're taking when they're buying calls and then they're on margin. I think that there are the Pied Pipers who sing the song and they make their trades ahead of the crowd. And then then they get the crowd to do what they want the crowd to do. And then they make their trade into that. I think that the leverage here is the thing to watch. If leverage starts to come down, then it's probably going to happen all in 30 to 60 days. I mean, it'll be fast. So we'll see. That first support zone in here, I would be surprised if it holds. If it does hold, that means that the world is healthier than I think. I think it's more likely to go down here. I have my QQQ orders in at 410. And people are like, are you out of your mind? And I'm like, if you take a look at the individual company stocks, the ones at the top of the index, right, the biggest companies, you have a combination of Head and Shoulders and cup and handles and all kinds of different formations and Elliott wave patterns. It is not hard to see lots of things doing what United Healthcare has done, pick a stock that dropped 20 or 30% in a week. It is not hard to see a lot of those stocks doing that. I think Google is vulnerable. I think Amazon is vulnerable. I think Apple is vulnerable. I think Tesla could lose way over half. I think Nvidia could go back down to around 100. It's 140 right now. To 100, that's almost 30%. So to lose 20 to 30% is just not hard, because the biggest stocks, which carry the most weight in the indexes, are vulnerable. All right. I'm going to skip over to, we're going to come back to Bitcoin. Teresa.
Yeah.
I want to go through just a couple of industries.
Okay.
We already did QQQ. SPY. Oh, by the way, folks, Berkshire Hathaway, Warren Buffett's not buying his shares right now, so you shouldn't either. How's that? I think that it's very likely that it gets down into this support zone at some point, and that's probably when they start to buy. So when it gets down here in jitterbugs, that means they're probably buying their own shares with their cash pile. So that's probably a good time to buy. So I think 450-ish is my target on Berkshire. And I point out Berkshire because, to me, it's better than the S&P 500. I think it's safer with a little bit more upside. Maybe not during FOMO rallies, but all the other times. So safer with a little bit more long-term upside, like a lot safer. I think Berkshire Hathaway is a lot safer than the S&P 500. So that war chest they have and all that free cash flow they have is a big deal. So if you want a core investment at some point, and you can get Berkshire around 450, which is where the trend line is as well, I think that this is probably where you're looking to get it. Does that sound about right in here for you, Teresa?
Oh, yeah, definitely. No, I like it. I like it going back to the trend support.
Yeah. And you'll see on some of the charts. Okay, so let's take a look at the technology fund. These ranges here are basically algorithmic trend lines, but this is technology, which is about half the economy now. You can see down here that it's starting to test, isn't it, on the RSI and volatile.
One of the One of the things I think that's so striking about that chart is the thickness of those candles indicate volume. And look at how skinny those darn candles are, those recent candles are.
Yeah.
There's just no volume out there.
Yeah. That was something we talked about on X, on that show that on Stocks on Spaces that I do the other day with Kevin Green, who is with Schwab Network. The low volume is reminiscent of retail traders leading the market. I just don't see the sophisticated money not waiting for a correction. I don't think they're going to chase. It would be very unusual for them to chase. So we just have to wait for an event, or just some of the big traders to cash out, and then they Pied Piper it down, right? They say, oh, it's too high, sell. And they have already sold, and they're probably short, right? So the Pied Pipers in these trading rooms, I'm just going to say this again. The lack of ethics in the trading rooms makes the Wolf of Wall Street look like a saint.
They're brutal in there.
That is, I'm not kidding, folks. I was offered money to write a short attack back when I was with Market Watch. They offered me 20 grand. Told my editor, he said they didn't offer enough. The stuff going on in the trading rooms is so dirty and dishonorable and unethical. If I were doing it, I would go to jail because I'm registered, right? I can't do that stuff. I mean, I'm kind of near the line just telling people what I'm buying. And you'll notice I don't talk about shorting stocks. I'll short indexes and industries, but I don't typically short stocks. SMCI, right? Supermicro was a rarity for me. The trading rooms online now with Discord, with everything else, they have to understand the impact that they have on markets, given that they have big groups of lemmings using leverage. So the inflection points are important. Now, you're going to miss some of the spikes, and they're going to happen fast. Just got to live with that. Take your 3 or 4% in your money market account. See, I got back to you, Tony. So
on the bottom of that chart, that bottom indicator is just an average trading volume value. The one further down, not the RSI. Yeah.
This one?
Yeah. That is at the same amount that it was back in 2008. And that's the first time that it's returned to that value since 2008.
What happened in 2008?
Gosh.
Did anything happen in 2008?
Just quiet times.
Yeah. Okay. So communications looks almost just like, right? The charts almost look the same.
They do.
So
the consumer discretionary is slightly different because the volume numbers are maintained. A little bit of they maintained a little bit, or no, not just the one that you were at before. That one didn't. The technology, yeah.
This is tech, yeah.
So
the reason I asked Teresa to do these 4 charts is these are, and remember, I started the day by saying for asset allocation, we just want to be in the right sectors. These are the 4 sectors that win, markets, right? Let me show you something. If I can remember where I put it. I remembered. I've been cleaning up my bookmarks. So what sector do you not want to be the leader? Of the 11 sectors, which sector, if it leads, is a bad sign? Where do you get your gas and lights from?
Oh, utilities.
Okay.
Also tells you there's a slight flight to safety.
Right. So as of yesterday, this was actually the leader. So today, utilities must have really fell. Utilities got crushed today. The day after, I talked about this on X yesterday as well. So the day after I talked about this, it got crushed. Energy got crushed too. Yeah. So if we get some FOMO here, I do like industrials. That's why I've got a new stock that I think I'm adding to the growth list next week. But yeah. The index is up 1.52%. I said it'd be a choppy year. I don't know. I feel like I'm pretty vindicated. All right, let's finish with Bitcoin because that's the sexiest thing alive. Tell me about Bitcoin, Shooter.
Man, we just need to get down to that 103,500 so I can put my position back on.
Yeah. So you think this line holds?
Yeah, the problem with what's going on with BOJ, which is why I closed my June futures.
BOJ, he means Bank of Japan, folks.
Correct. Yeah, it is that if they hike this time, we're going to have a confidence loss in the entire financial system. It'll be across the globe. Bitcoin, everything will come down with it. So that's why I came off here. I want to back test to 103 so I can add some further out risk. I want to go up to 120 strikes. But I want the pullback first, and I would like a deeper pullback. That's only going to be my first piece that I put on, and I've got it broken up into 5 tranches back to about the 23.6 if we get down to 88. I'd love to get back down to 92 or 96, but I don't know that it happens here with what's going on with stablecoin and all that stuff that I mean, basically we're building this whole network. Chase Bank, I don't know if you happen to notice my tweet out on that, but they're now accepting BlackRock's ETF as cash reserves for Bitcoin for their lending. That's absolutely huge. So that means you can own the BlackRock ETF, use that as collateral with Chase, and go trade treasuries or index. I mean, it's just a huge money generating vehicle for stocks, crypto across the board. I mean, because it's going to be billions of dollars really quick. Anybody who holds a big boat in Bitcoin will now be able to leverage their money when they were no longer, they were unable to do it prior.
Yeah. I think that we have to understand the motivations of the big investors, and we have to understand they don't really care about the small.
Yeah.
So I think that it is very likely that I think we might see the biggest pump and dump in history in Bitcoin and some of the other cryptos. I think what we've seen is just the tip of the iceberg. Now, that doesn't mean that I think it's going to be great forever. One of the things I talked about at breakfast with this guy that runs a trading room, and he dropped out of medical school because he was making so much money trading. He, it's just a catalyst trader, momentum. But he made a good point that I don't hear a lot of young people talk about. You've heard me talk about Paul Tudor Jones. One of the things that Paul Tudor Jones said was, a lot of people hate bubbles, but I love bubbles. I like to ride those bubbles as far up as I can, and then I get out before anybody else. Now, if you have that ability, if you understand that that's what you're doing, I think that you'll understand Bitcoin better. Now, a couple of years ago, I just thought Bitcoin was going to have wide adoption. It's been an evolving story since 2016 with me. I've made money on Bitcoin. You saw me do it. When it was here, I told you it was going to go down under 20. It did. We rode it all the way back up to 99, and I haven't been back. I do think it gets down in here because I think that shape is symmetric, and symmetry tends to work. So
I think we get the 121 first.
Maybe. I don't care about first. I mean, that's the difference between the way Shooter and I trade. I don't care about what happens next. I just want to know where something's going to go eventually and be ready to do something when it happens. I think it's very unlikely that it comes much below here because you have some big investors that probably want to get in on the pump and dump. The pump is going to come during the rest of this administration. The dump is going to come after that. I don't know how soon after that. But because there's an oligopoly developing in Bitcoin, I don't think it's ever going to become widely deployed. I don't think it's going to become the digital gold that I thought. I think that narrative will be out there. And I don't think that it's going to replace the dollar. I think the dollar has an incredibly strong 2030s. But for the next 4 or 5 years, I think that you're going to see a massive pump in Bitcoin because with the Michael Saylors of the world and the Trumps of the world and all the billionaires buying up Bitcoin, it's just becoming a big FOMO trade. And I think the next correction might be the last correction before it heads up to 300,000. Might go to 1 million. I don't know. But I have seen, remember a couple years ago, I said it'd probably get 300,000. I said my back of the napkin math says 300,000. Suddenly, that's the de facto number that everybody throws out there. So the narrative Pied Piper thing that's out there, the narrative machine, what people believe is different than reality usually. Everybody rationalizes. It's going up, I must be brilliant. It's going down, everybody's a fucker, right? Somebody else did it. I'm just telling you, I've seen this game enough times now. I've read enough. I've lived enough. I think Bitcoin is going to be a massive pump and dump. And if you think about it that way, I think that better equips you to ride the bubble up because I think it's coming. I think it's coming. There's too much money invested at this point, not only in Bitcoin, but in all the politics and legal costs that it takes to create this pump and dump. And I'm going to write an article about this. I think that Bitcoin, people are going to say, well, it's already at 100,000. The pump is over. No, it's just starting. The pump and dump that is coming from now until the next really big recession where everybody just needs the money we're in play. So if we get this correction down to in here, I'm going to buy it. I regret not buying it here because we talked about, I mean, like right when it was there, I talked about it in the chat. I said, I'm really thinking about Bitcoin right now. Then it went up like the next freaking day. So, I mean, because I do look at this stuff. So if we get this correction, makes the M, should jitterbug, and then wee, and we might not, might jitterbug a while, but we're going to get QE next year. I cannot see a way that we don't get quantitative easing next year. So remember I said this. So that next year when it happens, you go out and tell 10 people, this guy told me a year ago what was coming. We're going to get quantitative easing next year. It's going to happen. And that will be the rocket fuel. So between now and next year, we got to find an entry because next year we're getting rocket fuel. Now, I don't think the rocket goes as long as some of the other rockets, but it might go straight up because all the retail guys, right, they believe what they believe and they use leverage and they're smarter than everybody until they lose 80% of their money. Let's see. Where's Teresa? Where's your Bitcoin chart? Where did I put it?
I didn't do one specifically for this. I
think I found one though. I have one of your Bitcoin charts.
Okay. Yeah, I have mine. I've got it up right now too.
Well, it's not that important. What do you think?
I think
here it is.
Cool.
Oh, this is IBIT.
Okay, yeah, that's a daily too.
Same thing though. That's fine. That's fine. That's fine. So you're looking at 50-ish or 55-ish.
So on IBIT. So on Bitcoin itself, I thought it was really interesting that price just traded right down to weekly trend support and then just pushed off away from that. So I think that Bitcoin loves a trend.
Well, it has been one of the purest technical trading vehicles out there for a while.
Yeah.
So because there are no fundamentals, right?
Yep.
It just trades with the technicals. All right. You can have the last word on gold because everybody wants to know about gold. I think it's pretty. What do you think?
Myself, I love gold.
All right.
but not necessarily.
But you think there's a correction coming?
Yeah, for sure. I mean, that's a weekly chart. The RSI on the monthly chart is insanely high, and it's high on the weekly. Yeah. So
this is a 3 drive. That's a 3 drive.
Yep, looks like it.
Okay, just want to make sure you're the authority.
Yeah, that whole structure is a mound. So I mean, yeah, your clear 3 drive is on the last push.
Yeah, it would be so easy to see it blow through that weekly buy zone and then jump down to that monthly.
Yeah, I don't see gold going under $1,900 an ounce. So the closer we get to $1,900 an ounce, the more likely I am to trade it. But if Bitcoin is coming down the same way, I'll probably split my bet up. I have owned a gold ETF in the 401k that I've managed, and I haven't changed the asset allocation in months. That's why there's no updates. But I'm pretty sure that I'm going to make that 401k a little bit more conservative tomorrow. So because it's retirement money, right? They don't want to take a lot of risk. So, all right. Any questions? Anybody on the macro? Call it a day. Go play some online poker. Teresa's getting ready for the World Series of Poker.
Yeah, there were a couple questions in there. What do you think about TLT?
Oh, hold on a second. Now, we already talked about TLT. We did quite a bit on it, so I'm not sure if you were on at that point, but basically we're saying that lower 80s if interest rates don't go higher, 70-ish if they do. Crowding out is important. Watch the recording tomorrow.
And then one other one, the current idea about the cash percentage, where do you think everybody should be?
What do you say? What was the question?
What is the current idea on a cash percentage in the account?
I'm at 60%. but some of it I have cash secured puts written against. So you never want to go really more than 80% cash because you're just being too speculative and you're just trying to be too perfect. The reason I have gotten to 60% cash is because I write cash secured puts against a portion of it. I think most people should really never be more than 40 to 50% cash because, again, you're trying to get both ends of the trade and most people aren't good at it. So a way to kind of like throttle yourself or govern yourself is not try to be too perfect. So just expand your equity asset allocation to 80 to 100% when after big corrections, and then gradually over years, especially the last year of an up market where you're kind of at the point we're at now, where like coin flip if it goes up 5 or 10% more, or it drops 20 or 30, right? I mean, when you're at this point, you should be scaling out a little bit, a couple times a month maybe, until you get to the point where there's just not a lot to buy. And right now, there is almost no large caps that I want to buy. There is very few mid caps, very few small caps. There's not a lot of growth at value prices, right? And that's what you want. You want growth at value prices. And there just aren't a lot of growth items at value prices. As far as Nvidia and Apple, I am not in either one. I'm just waiting for a chance to buy QQQ cheaper. I don't know if that's 450 or 410-ish. I'm hoping it's 410-ish. That'd be better for me, So as far as me caring about the world like I do, I feel bad, but I feel good too. So I'm not really too interested in buying companies that are near the top of their S curve. I think Apple is closer to the top of their S curve than Nvidia short term, but I don't know what Apple is going to do going forward because everybody still is in that, they're half of the US market or more. They're just such a huge, they're clearly the top consumer stock in the world. So can they create something, glasses, right? They're attached to your iPhone. Can they do something that just keeps people pumping money into them? The thing with Apple, though, is it's become cyclical, right? So it's the replacement cycles. So when people start to drift out of it, 6 to 9 months ahead of them doing a bunch of stuff, it's when you start to buy it again. And that's played out the last 2 times over the last 6-7 years. Nvidia, I think that the company is awesome. I think that losing the China market's a big deal. They're going to offset it with Saudi Arabia. Had they not lost China, Saudi Arabia would have been pure growth, right? And the OCC countries. Nvidia is getting a lot of Middle Eastern business now. Huge. But it basically just replaces what they're losing in China. So that's a big deal. The valuation of stocks goes up when growth is accelerating. The valuation of stocks goes down when growth is decelerating and finally gets to be low or negative. A third of the companies in the S&P 500 have basically no growth. I hate them. I don't care if they have a 6% dividend. I hate them. It's like Doc Holliday. Should I hate them? I should hate them. I hate them. So with Nvidia, it's probably better than SPY, but it's not as good as the next company that gets from the mid-cap index into the S&P 500. How's that? Those companies in the middle of their S curve will do better than the ones at the top of their S curve. It's that simple. Maybe more volatile, but hey, when a CEO says I'm selling $1 billion in stock, that ain't for buying a boat or buying another house. That's cashing out, folks. So, all right, I don't see anything else. Okay, let's call it a day. This took an hour and a half again. I'll get it edited tomorrow. Probably be out on Saturday morning, so you can listen on Saturday morning. Somebody asked, so I'm not going to talk about more stocks, but no on your question, Vince. That's too big.
I'll post it in chat.
Yeah, that's too big a position in that company right now. All right, everybody, have a great night. Thank you, Teresa. Thank you, Scott. I think that we're getting the hang of this.
Beautiful. Thanks for having me.
And yeah, we'll see you soon.
All right.
Yeah. Good night, all.
Until next time, folks. Have a good night.
Last time, if anybody's in Vegas in June 16th to the 23rd, I'll be there playing in the World Series of Poker. So just come and start yelling hee haw, and I'll know that you're there for me. All right. Take care, everyone.
Bye-bye.